Hello, everyone. My name is Bianca, and I think we're ready to go. Just want to tell you that I'm from Funding London, which is an early stage investment fund, institutional investor. And I'm delighted to welcome you all here today. I do hope you're keeping well and all sane in this 7th week of lockdown. I do want to bring to your attention that this session is organized in partnership with the London Growth Hub. They have some more information on their website, so if you haven't checked it before, please do go. Again, some useful information for all SMEs out there. Moving forward, and without losing any more time, I do want to introduce the speakers that we have today, and I do first want to thank them for taking the time to join us. I'll start with John Spindler, who is the CEO of Capital Enterprise. And just tell you a bit about Capital Enterprise. It's an organization that has been on the market since 2004, and so far they have helped more than 3,000 businesses raise external capital. John is also an early stage active investor, and he has co-founded the London Co-Investment Fund and AIC. John, thank you so much for joining us today.
Happy to be here.
Wonderful. Our second speaker today is Chris Smith. He's the managing partner of Playfair Capital since November 2018. He focuses his attention on seed and pre-seed businesses in UK and Israel. Previously to Playfair, Chris was an angel investor. He closed 14 deals and had 3 successful exits. And he was also an investment manager at Bramden Investments, founder, and also corporate lawyer. Chris, thank you so much for being with us today.
Thanks for having me, Bianca.
And then last but not least, we have Oliver Richards. He is a partner at MMC Venture for the past 2 years now. He focuses on fintech and business-to-business enterprise SaaS investments there. Previous to MMC, he spent 5 years at Monetize, where he saw the company growing from 100 employees to more than 1,400, and finally get acquired by Fiserv, a financial service technology. Ollie's VC experience was gained at Blue Bear Capital, where he was a venture partner focusing on technology investments across the US. Ollie, it is a pleasure to have you here with us today. Thank you so much for joining.
Also delighted to be here. Thanks, Bianca.
Thank you. Thank you to all 3 of you. Great. So without further ado, John, I have the first question for you. If you could give us a bit of an overview on the Future Fund and Bounce Back Loan. I mean, the government so far has been putting together a few schemes to help the business sector, but these are the 2 ones that I think they're more relevant for our audience today.
Okay, I actually probably think the furlough scheme, the job retention scheme, is probably being used by more people than any other scheme for tech startup. And obviously, we'll find out in the next week or so whether that's going to be extended beyond June, when D-Day happens for the British economy, when we see how many of those 6.3 million people really have a job when the furlough scheme basically stops. So the government support schemes at this stage are all about trying to basically preserve and freeze the British economy so it is still there when it comes out. And the next rounds of funding, which probably will emerge, will be more about stimulating. So to give you where we are, the bounce back loans got launched on Monday. They are a version of the CBIL loans. Basically, they are basically up to £50,000. It's a pretty simple application process. I suppose the big requirement for startups is they must have revenue, and they can only get up to basically kind of a limit. They must have like a minimum revenue of basically 200,000 or something like that. 25% is the maximum they can get on the bounce back loans. There are 46 providers that are doing the bounce back loans, all the big banks, some partners of Funding London like FSE, Finance Southeast is also issuing them. So if you haven't looked at them, do. And they're also, for those, should watch out next week, which should be launched, is tenants of co-working spaces in some council areas in London will also be able to get access for the first time to the business rate grant of between £10,000 to £25,000. And details come out that on Thursday. And hopefully we will be helping at Capital Enterprise some of the co-working members who are being locked out of their premises and have had a detrimental effect on their ability to trade, will also be able to get that small amount of money. But I suppose the thing that we've been mainly working on at Capital Enterprise is the development of what now called the Future Fund, which came out of a campaign we ran, which originally we called the Runway Fund, which was to extend the runways of startups that have raised previously basically pre-seed, seed, Series A rounds, so they can get to the middle of 2021, if not beyond, when we hope the full basic investment market would have returned. So the Future Fund is going to be administered by the British Business Bank. It should be launched, we think, any day now. Speaking to ministers yesterday, we think more like Monday or Tuesday. It's going to be 250 million from the government. Basically, it's going to be a convertible note. The convertible note, as it stands, there'll be some amendments to what it's been published to date. But as it stands to date, that convertible note is a 20% discount on the future rounds. The government intention is that that converts into shares on the future round, and there's quite a penalty if you decide not to convert it and get it and repay it. It's quite an expensive, because 100% premium and 8% interest. If you do decide over a 3-year period not to repay it, or you don't repay it, you can't get a next basic follow-on round. We think it's going to be massively oversubscribed. We think it'll go fairly quickly, and the key aspect is going to be your private match. At the moment, it will be your investor that applies with you. No investor can't get it. And that investor has to, at the moment, invest on the same convertible note as the Future Fund, which unfortunately, as it stands today, and this may be the big change before its launch, is not EIS compatible. So EIS investors, people that want that tax break, EIS funds, VCT funds, will not be able to presently offer that match to invest on with a Future Fund on that convertible note. We are still thinking that might change. We have hope. Hope is the right word. Expectation, probably not, but hope definitely. But that still may be changed before it's launched. I think the government ministers want it to happen because they know that at seed, roughly 75% of all rounds have EIS. And at A to B, it's around 40 to 50%. So obviously it wasn't the government intentions to lock out all of that money from basically matching them in these times of difficulty. But as it stands, that's what it will be. We will, once it's launched, basically my advice to you is if you're not already doing it, is speak to your existing investors. And to see, because vast majority of that money will come from your existing investors, the vast majority of the match. It's going to be hard, given the time frame, given where we are today, for you to go out and raise new money to basically then to apply to future funds and then to basically get it, because we think the fund will be pretty quickly taken.
So the key is keep your investors close, your previous investors
close. And don't forget what people will find. There are ways around that. I mean, we've been speaking to others at the moment, some IR portfolio, some of the portfolio of LSIP, where they're probably going to do 2 rounds. They're going to do a future fund compatible convertible note, and they'll probably do a price round for those that can't invest, and they'll do in 2 separate documents, and there'll be some connection. Be very interesting, because a lot of the conversions, I suspect, actually may happen a lot quicker than the government expects because of the price thing. Because the people that need price rounds will probably, if they're going to do it, will probably still come in on price rounds. So that's the future fund, the bounce back loan. But the largest amount, which may be relevant for your audience, the largest amounts of money that the government's put forward to tech startups is through Innovate UK. And Innovate UK and the Future Fund will open apparently on the same day. The government wants to do it all under their basically initiatives. And I suspect that'll be Monday or Tuesday. And that is £750 million to be spent over the next 12 months, less than 12 months. And that would be what I would, look at. And for the pre-revenue companies, basically, they are going to issue out £211 million Innovate UK in grants of 175k. They do not have to be matched. Basically, 2 tech startups. They have to be tech. They have to have a tech, what we call tech related level, transfer related level, between 5 and 8. We're going to do that to 1,200 new companies that have never received Innovate UK money before, but are less than 3 years old.
Okay, so there are some important news coming up in the next few days, isn't it?
To be honest, looking at your portfolio and mine, I suspect they'll get more Innovate UK money than Future Fund money.
Mm-hmm. And what about the bounce back loan?
The bounce back loan is there, but obviously, and it's a debt instrument, and obviously traditionally, basically venture-backed or angel-backed, basically startups tend to not like to take debt, but it is there. It's 100% secured by the government, sorry, but the bank will chase it up. It will be seen as a bad debt. So if you don't repay, it's still, you will still have a bad debt mark on your basically credit history, both as a company and as a director.
Thank you so much, John. Now, I do want to move to the second question that we have for you today. And given the current situation, I would really like to hear from you. Which sectors do you think investors will have an appetite for post-COVID-19? Which will be the hot sectors coming up?
I think the realization for most investors and probably most of the public over the last 3 or 4 weeks is there's not going to be a post-COVID. Is that COVID is here for the next 2 to 3 years. And we are not going to snap our fingers and go back to February 2020. The world is different. And certain industries are going to be massively affected by the social distancing rules. They're going to be massively affected by the inability to travel without quarantine. They're going to be massively affected by the obvious depression and recession that's going to happen basically post this to certain sectors. So it'd be false to say that you can basically say there is a post-COVID world. That we are in for the next 2 to 3 years until we have a vaccination, a COVID world. And that's going to be very different. Some sectors obviously are more protected from that than others. And I think some thesis-driven VCs, it'd be interesting what Chris thinks on this, and to Oliver as well, because they both have strong theses, maybe adapting their thesis to look at this. A lot of VCs don't. They rely on they invest across sectors, across basic stages, on the performance of that startup or scale up in that market. But I think some of the theses will change substantially. Obviously, I would say this, but I think deeper tech startups may be an advantage over others, partly because they're not as disrupted by the market. They're basically building for markets which are a year to 2 years in advance. 2, because I think this basic COVID has shown the importance of technology, the importance of data, the importance of being able to automate, to take the human out of the loop. And I think startups that are building technologies in that area will have a big advantage. But beyond that, I would hate to say, because if I said hot sectors now, basically they're probably wrong. I know sectors are going to be pretty difficult. I'm probably not going to do travel. I'm probably not going to do entertainment, basically physical entertainment or physical socializing. Myself, I'm probably not going to want to do anything around corporate property or proper prop tech until I know what's going to happen there. So there's probably certain things that and I may be prejudiced. It might turn out actually there are fantastic opportunities in that thing for new business models to emerge. But I will wait in those sectors for startups to generate those new business models.
Then maybe the question should have been, which sectors do you think will be most affected? And you have answered the question so far. Thank you. So I do have another question before we move to our second speaker. And I do want to touch upon the diversity and inclusion because it might be the case that certain groups of founders will be more affected. And I do know that Capital Enterprise, an organization that you're a CEO for, you've got a wonderful program, One Tech, and you do a lot of work on this, the diversity inclusion in the early stage ecosystem. How do you think this will affect founders, or do you think a certain group of founders will be more affected by others due to this crisis? Do you think that funding gap will deepen?
I think that diversity angle is a very interesting one. I know Chris should probably answer this as well because he's got a big program at play for the same around female founders. I think there's three things that we probably know that we've tried to address over the last 2-3 years, and there was a fear, but obviously that basically companies that are pre-seed or early seed will find it much more difficult to survive and get the follow-on funding than companies that aren't product market fit or with data proving that they're fit to scale. And what's happened over the last 2 to 3 years has been a concerted effort to get more female founders funded, to basically diversify basically both the VCs and those that they invest in. And there is a danger that we wipe out that 2 to 3 years progress we've made and go back to anyone that was funded in 2015-16 when the figures on female founders was even worse than it is now. It's not great now. So I think 2 or 3 things. I think female founders and BAME founders traditionally, because they may have less social capital or less access to high net worths, may find it difficult to get the match for the for basically things like the Future Fund. And so we are concerned about that, and we're actually looking to see which ways we can get around that and find new money that basically can particularly fund those types of founders. I think certain things will be interesting in the sense of what female founders and BAME founders are sectors that they predominate in. Some may do really well out of it, actually. I think Chris has got portfolios in for instance, in digital health and in basically telemedicine, which basically will particularly probably do quite well in this area. But, you know, I am concerned, and I am concerned that it does in China. We're going to do quite a bit at Cap Enterprise to try and equal out some of those. We had a great webinar on Monday discussing this factor. But yes, I am concerned. I don't think I have any ready answers, but it is something there.
John, maybe you can drop in the chat a link to that webinar, so whoever is interested from this audience can join your the webinar on Monday as well. Okay, great. Thank you so much for your insights so far, John. If the audience, if you have any questions for John, please do leave them in the chat. And then at the end, after we've discussed with Oli and Chris as well, we're gonna bring John again, and then he can answer your questions. Okay, so moving forward, Oli, I'll bring you in the front. Let me just unmute you there. Last week, Local Globe have released a report they have done in collaboration with a few VCs, and MMC were one of the partners. And one of the key findings was that 40% of the companies that were surveyed saw a revenue drop of at least 25% in March, below the initial projections. So my first question for you, Oli, is that what kind of implications do you think this will have on future fundraisings? And then what's your advice for those businesses that have seen this drop but are still in a desperate need for an injection of external capital?
Hey, thank you, Bianca, for the simple question. I think I should start by saying, yeah, that this survey was widely distributed amongst the UK, like the VC-backed UK startups, and I think the longer-term projections, like the outlook for the calendar year 2020, was a greater number of people seeing a revenue drop. So I think the answer for businesses that have got a reasonable amount of revenue, don't quite define reasonable, but have a number of clients paying, I think it's going to be very normal that this year is going to see some contraction, right? We're entering a recession, as John's talked about. There will be exceptions, as always, but I don't think that as an investment community, we're all going to be expecting to see every business have a chart that continues to go up to the right through 2020, right? This is clearly an unprecedented market dislocation, and therefore the kind of people mustn't worry too much about the charts they've been so used to seeing for the last 8 to 10 years from startups showing that smooth growth. I think this is obviously dislocation. So that's my first point, I guess. I think in terms of investment, I think John pointed out, and I agree with his point. It's all about stage. I think at an earlier stage we have some early revenue, but you're not necessarily expecting to hyperscale for the next couple of years. I think there's a very strong case to say that you're still very investable. You're building a product. You're probably working with a couple of clients, building out the proof of concept, iterating, and you've got a couple of years of product development ahead of you before you need to really go to market with lots of money to build out sales and marketing. I think at a later stage, it's obviously a slightly different story. So people with high burn and who have been kind of following the US blitz scaling model, maybe it's going to be a much harder model now. It's, you know, selling into a recession is obviously harder. Maintaining growth rates is obviously going to be very tough. So I think there's going to be a paring back of that burn rate, and I think there's, you know, that type of trajectory. Or, no, fully appreciating there are absolutely exceptions to this in certain markets and certain areas where actually there's a huge opportunity for scale. But as a general rule, particularly like in B2B enterprise SaaS, which I guess is where I'm primarily talking about. And I think from a founder perspective, I think taking advantage of all of the government help that you can, as again, John's outlined the various sources. I think the furloughing scheme, and as John's spot on, you know, the end of June is going to be an interesting moment. I don't think we're going to see a cliff. I think they're going to have to extend it, and wind it down in some sort of tapered way. I don't quite know what that's going to look like, but certainly there's a lot of people have been furloughed, and so that doing those sorts of things to preserve cash is obviously sensible and what founders should be doing. I think does that answer the question?
Yeah, it does. Yeah, it does. And then in terms of, like, for example, would you say that obviously they have to be honest with investors, and, you know, they have to admit that they had to pivot or, you know, adjust the projections and so on. But I think, do you think that investors will be sort of okay with it because they haven't reached, if they're a seed company and they want to go to a Series A, they won't be, most of them won't be able to reach the milestones?
I mean, it's such a tricky question. It's a case-by-case basis. I think obviously the market has changed, so people will understand. And, you know, I'm spending a lot of time going deep into the impact of the crisis and thinking through what the new normal looks like, and therefore what the new normal for, you know, our portfolio and potential new investments looks like. And therefore, I think it's much more around having a story around how you're going to operate moving forward, and how you're going to be building a business moving forward in this new environment. And I think, you know, again, John mentioned it, but if you're impacted by social distancing and, you know, reliant on warehouses and capacity of maybe face-to-face engagements, I think that's going to be a very tough travel. You know, like real estate. These are all going to have fundamental changes to the way that the business needs to operate. Again, if you can paint a story there and you think there's a real opportunity for you to build a business, I think there's absolutely a chance for you to get investment. On the whole, though, I think you know, the seed to Series A and the Series A investment right now is wherever possible. I think, you know, valuations, and I think you're probably going to ask me about valuations now because you put the slide up.
I think so. I skipped it too quickly, but yeah.
You know, I guess it's a tough time to value a business right now, right? There's very few data points and a huge amount of uncertainty. So where possible, taking a convertible loan, or, you know, putting off the need to actually draw a line in the sand with a valuation today, if you are raising money and need to raise money right now, is advisable and probably preferable. And I think, again, it's a stage thing. I think you know, we're still seeing reasonably strong valuations being achieved by relatively early stage businesses. I think that's much more around, you know, founder dilution and amount of capital being raised. It's kind of relatively basic formula. I don't think, you know, that's going to fundamentally change. I think later stage at the moment is a little tougher, particularly for businesses that have seen, you know, we have some large digital consumer businesses in our portfolio. Generally, they're all doing very well. Everyone in retail, which is you know, surviving and actually doing remarkably well, but certainly growth rate has reduced, and therefore, you know, the growth rate was a big part of the valuation of that business. So naturally, if we were looking to try and invest in that business, or someone else externally was trying to invest in that business, it's likely to see a slight decline. But, you know, we're doing all we can to conserve cash and look to get through to next year.
So there you are. You answered my second question as well, which was quite a difficult one, because I think the founders nowadays are quite concerned about their valuation and how is that going to be affected by the crisis in the next 6 to 12 months. As you said, it's on a case-to-case basis, and, you know, it really depends. It can go up, it can go down. I definitely anticipate that in most cases it will go down, but there are those odd odd businesses that are doing very well and they well placed in the market, and their valuation will go up and they will grow. We'll go to the third question, and then this is sort of a more
give you all the easy ones here, Bianca.
yeah. Well, how do you see the ecosystem moving forward at an early stage? I mean, do you think that people will still invest as much as they did? Because before this crisis, there's enough capital in the market. We just have to find the right businesses to invest in. How do you think, are they going to be more investors? Are they going to be more cautious? Or what do you think is going to happen?
I think it's a really interesting question, and I think it's a very difficult question to answer. I think there's a lot written about the amount of dry powder in the ecosystem, and certainly there's a lot of the large generalist global funds raised huge amounts of capital in the lead up to the crisis. So there's no doubt there's a lot of capital out there. Whether and how much of that gets directed to current portfolio and kind of supporting and maintaining the current portfolio versus going into new businesses is a bit of an unknown. But nonetheless, I think there's absolutely an environment where investment is going to continue. Obviously, at the moment we've been through a huge period of uncertainty, so there's been a significant drop off in the number of deals being done. Advice to portfolios is to hunker down a bit, try not to go out and raise right now. But I think we're expecting to see a little bit of a increase in the number of businesses coming out to raise maybe in Q3, and I think that's based on just the fact that there's probably quite a few businesses that need to raise around now and are probably stretching themselves to come out a bit later in the lead up to Christmas. And certainly how it's working out across our portfolio. And I think next year, I think that it could be a really interesting time to invest. Certainly LPs. I was quite close to a friend of mine who's raising a fund right up to the end right up to the beginning of the crisis, and LPs were very much talking about the high valuations and the toppy market and how is thinking about deployment of capital and ownership, and actually that messaging is going to fundamentally change now. I think there's a view that moving forward, it's actually probably quite an interesting time to invest. And there's no doubt there are sectors and areas, and John did well to kind of avoid the specifics of calling out sectors, but there are absolutely areas where there's going to be huge opportunity. And that's what, this is when entrepreneurs thrive. Great entrepreneurs with great business ideas are still going to get backed. And the ecosystem is so different now to what it was like in 2008, 2009. It's much more mature. There's many more investors at every stage. And so I think I still feel, I'm a natural optimist, but I'm still optimistic about the investment environment. I think it should be seen as an exciting time for entrepreneurs. I think we're going to see some really interesting businesses being built over the coming years.
Yeah, and for just I want to mention something for those people in the audience who don't know. MMC do usually invest at Series A, but they also have an early stage fund. Okay, thank you so much for your insights. For the moment, those were my questions. And again, addressing to the audience, if you have questions addressed to Ollie, please do drop them in the chat, because we're going to go back to Ollie at the end of the session. We still have a few questions for Chris, and we'll open afterwards to the public. Chris, with you, I would like to discuss more about the interaction with the founder, during this crisis and their well-being. So my first question is, how do you continue to meet new founders? And how hard is it to take an investment decision, if you haven't met the founders face to face?
Yeah, interesting question. I think the first thing to kind of note is that we are all in this industry extremely fortunate that we can actually carry on our jobs pretty much as we did before. So, obviously there are less networking events, there are less conferences to go to where, founders and VCs could connect with each other. But that said, they've been replaced by things like this, lots of really good virtual events and conferences where, again, founders can meet up with investors. So I think there are still events, albeit virtual. We've got an open pitch us form on our website, so founders are able to submit their deck and information to us. That hasn't changed because of the pandemic, so we're still seeing a lot of inbound deal flow through that. actually founders may have a better chance of getting attention through cold approaches, through email and LinkedIn, because we're all sitting at home for many hours, we're not commuting anymore, so perhaps there's a little bit more of an opportunity there. So I actually think now is not a bad time for founders to be connecting with VCs. There's obviously a separate question around whether those VCs are actually investing, but we might come to that later. So I think from a founder's perspective, not too much has changed for the worse. In terms of doing deals fully remotely, we sat down as a team when we went remote ourselves, and we thought actually this is going to be quite tough, because when you're investing at seed stage, it really is all about the relationship with the founder, and making sure that you really understand that team. And it works both ways, of course. So the founder needs to be able to build a relationship with the VC and make sure it's the right sort of fit. We've surprised ourselves. So we've done a couple of deals that we're closing that were founders we met prior to the lockdown, which will close in the next couple of weeks. But we're actually just about to get to long form legals on a deal that's been fully remote. So I think actually founders can shine through video. It surprised me, but it's definitely true. So again, I think we will probably be doing slightly fewer deals this year than last year, but it is only slightly. So I think doing deals fully remotely is possible, and we've certainly heard about other funds doing it as well.
Yeah, it's really good. So we get the same message for you. You're open for business, same as Ollie. And I think it's about the previous weeks is about, from an investor's perspective, finding your ground and how to interact. But then once you get into a routine, you sort of resume the activities, to be honest. And that's a good thing to hear, I think, especially for founders. Going to my second question for you, Chris, how comfortable do you feel investing alongside government schemes, and do you think there are any sort of challenges around that?
So I think John did a great job both advocating for the scheme and getting it, being part of having it put in place, but also summarising it as well. Yeah, I think from our perspective, there are some wrinkles, that can make it tricky. I think probably the biggest one for the convertible loan scheme is EIS, and it impacts. Actually, we don't care too much about EIS as Playfair, but of course angel investors do. And so if you're trying to bring an internal round together and on a convertible note, a lot of the angels are saying, yeah, look, I don't really want to put my money into that. I really want to get the tax breaks that come with EIS. So if that can be resolved, that would be great. There's probably a secondary question then about the size of that fund. It's probably not big enough, but of course it never will be. So we're perfectly happy to invest if it fits the individual circumstances of the company. I think anecdotally, we've got one company in our portfolio that will almost certainly use the scheme, but it is in a round of $5 million plus, and they are very much later stage, having been around 5 years. It just so happens the terms of the scheme fit where they're at. Of course, ideally, this really wants to be covering sort of the valley of death, really, between seed and A. And I think with that EIS tweak, it would certainly help.
Yeah, totally agree with you. And then the third question now, because I gave a bit of a hint before, we're going to talk about the well-being. How important do you think is the founder well-being, and what's your advice for those founders who are mentally struggling during this time?
I mean, I think well-being and health is the most important thing for everybody. So, frankly, in a time like this, if you and your family and your loved ones are well, that's great, and the most important thing. So let's start from there. I mean, I think, founders have unique challenges and unique strains. It is incredibly hard to build a business. I think the pandemic just magnifies that. So if you look at the stats around VC funding, I mean, just from Playfair last year, we saw about 2,500 potential opportunities. We did 9 deals. So, the numbers have always been hard. maybe it's got 3 or 4 times harder. So I think founders need to be very robust. They need to get used to people saying no to them. And I think for me, what I always tell our founders is, make sure you've got a good support structure, not just professionally. I think it's really important that you're aligned with your co-founders, that you share the work. If someone's doing all the fundraising, someone needs to be keeping the wheels turning on the business. But I think personally as well. So, having support at home, support from your family or whatever, I think is really key. And I also think the biggest thing we've seen coming out of this is that everyone is impacted very differently by working from home. So you've got people working from home and maybe living with their partner or their family. Great, spend more time with the kids, spend more time with whatever, it's fine. You've got other people working from home who may be younger, just moved to London, they're in a shared flat with someone they don't really like very much, they haven't got a balcony or outside space, they're miserable. So I always encourage people to think about this from a very personal level, think about the personal circumstances of the founder or the members of the team, and then try and react appropriately with whatever it is, team meetings, benefits, all kinds of, we've had silly hats, we've had yoga, we've had all types of things, but I think just recognizing people's personal circumstances and trying to adapt to them is really key.
That's really good. How big is your team, Chris?
6.
6, okay. It's really good to stay close to your employees during this time and take care of them, isn't it?
And I think so. Just one thing that I think is happening to everyone is that it's very easy to end up with back-to-back Zoom calls from 8 in the morning till 7 in the evening with no gaps, because everyone knows you're available, you haven't got to commute, and you're not getting a break and you're not getting the stimulation of outside. So I'm encouraging my team and everyone we talk to, just take 20 minutes, take 40 minutes, go for a walk, get some sunshine. I think those things seem trivial, but if you don't do them, they'll build up and have quite a negative effect.
Yeah, and it's also the kind of a groundhog day when you wake up and then you have a shower, brush your teeth or anything you do, you have breakfast, go into in front of the laptop and go zoom, and then you have lunch, zoom, and then dinner, and you're going to sleep. So it's it can get quite confusing, like, oh, what day is today? But before we go to the general Q&A, Chris, I want to bring to the public's attention a wonderful initiative that Playfair Capital has put in place along with Tech Nation, and that is the Female Founder Office Hours. And it's a mammoth activity, because I think you're bringing about 100 female founders, and then you have around 30 VCs participating. Would you be able to tell us a bit about that?
Yeah, absolutely. So, John was touching on his concerns around diversity, which I absolutely share. We actually came to the female founder issue through one of our investments. So we invested in Vine Health, 2 amazing female founders, Raina and Georgina. Had never really considered the stats. It was only when we were putting out the press release about the deal that we saw them and thought that's just terrific. So we've had 2 female founder events, again in collaboration with other funds at our office at Warner Yard. They were great. And we sort of thought, actually, now more than ever, unless you have warm introductions to a fund, it's really tough. These virtual events are good, perhaps not as in person. So we just wanted to scale it up and see what we could do. So my colleagues Henrik and Ali sort of spoke to a bunch of VCs. As you said, we managed to get 30 different VCs together. Perhaps an upside of the pandemic. I don't think you'd ever get 30 VCs in a room normally, but of course they're all happy to join on their laptops, and opened it up nationally as well. So I think there's a lot of focus around funding in London, but of course there were good businesses all over the UK. So I think we've now had, we had over 1,000 founders start their application. I think we've got about 150 through. So I don't know quite how we're going to fit them all into one event. Maybe we'll have to do a couple. But the idea is to open access. So it's to give founders a route to meet VCs, to make that initial connection, and then use that time as they want. So they get 15-minute slots. It can be a pitch, it can be asking questions, it can be trying to get a follow-up meeting. And we've written a blog post as well, which I'll share, around how founders can get the most of the event. Because one observation we had is that founders don't necessarily know, particularly if meeting investors for the first time, how to make the best of the opportunity. So we want it to be not only access, but we also want these meetings to be impactful as well.
Yeah.
So yeah, on the 4th of June, and you've put the link up there, I can send around the blog post as well.
Yes, please. If you could share also a link in the chat for all who are interested from today's audience, that'll be really good. And because I've got you here, Chris, there's one last thing that I will go around and ask also John and Ollie. What's one piece of advice that you have for founders under current circumstances?
Ask your investors searching questions. And what I mean by that is I usually encourage founders to ask very directly, what's the process to get to a term sheet? So how does the IC work? Because I see lots of founders getting knocked off by building a great relationship with a single person and then going to this strange room full of often older men as an IC, and someone they've never met says no, which is a really dissatisfying experience. Now you need to be asking questions around how many new deals are you planning to do this year? What is your process of getting to, or doing investment committee, getting to term sheet remotely? And have you done any deals remotely so far? I think those questions will help founders work out if they're spending effective time with that investor, and whether it's realistic they're going to get around the way during the lockdown.
Yeah, some really good advice, Chris. Thank you so much, and please do stay with us because we have a few questions that come up. I'm going to move to John now. And John, what would be your one piece of advice for our founders under today's circumstances?
I think they should basically use their imaginations, because I think what I'm finding for founders is just a hope that everything will go. I would like them to basically spend more time thinking about the opportunities and having new insights about how their own business, their sector, the population are going to get through the next 2 to 3 years. And for them to kind of not to be on the same tram lines, product market fit will look like this, but to review everything and to think about their own business in light of that. Because I think what I'm looking for is new narratives that says this business can succeed in this market, and not that this business was succeeding in the past market and let's hope it comes back. Because I think that thinking is probably not the right thinking at this stage.
Yeah, that's really good. Thank you so much, John, for your advice. And Ollie, what would be your advice for our founders today?
I guess on top of those, I'd go back to something Chris was mentioning, which is focusing on the people. So focusing for those with teams, focusing on the well-being of their team and themselves and family and loved ones is probably the most important thing. I think, particularly entrepreneurs who are some of the most hardworking people in society anyway, that the temptation to being at home all day and working every hour of the day is sometimes too much to handle. And so it's all about ensuring you've got, are taking a break, as Chris talks about. You are making sure that the well-being of the staff. If you've had to furlough people, the act of furloughing, which is probably a word that most people have never ever used up, prior to March, but doing that remotely. So trying to explain to employees that they're not to work, but will continue to get paid, and they may have a job hopefully when they come back, and then kind of hanging up from Zoom, and then hoping that they've got a kind of comfort community around them to really understand the implications of that. So spending time with your team and really making sure that they're coping, and that you're doing all you can as an individual to cope. And I think we're getting to a new normal. I think people are starting to really understand that this is going to be a long-term thing, and so hopefully most people have now got to a point where they are able to cope. But it's so important to keep reinforcing that. Yeah,
just to summarize that, I think it's very, very important for founders to take care of themselves mentally and physically during this time, because if they're not well, nothing around them will be well. So, and also if they got employees, those employees count on them. So do take care of yourself during this time. Great, thank you so much to all three of you. Now I do have some questions from the audience, and the first one is from Zach. And John, if you don't mind answering this one, is about what have you seen a change in the appetite of angel investors so far, or?
Yes, I mean, obviously, I also do angel investment myself. Obviously, the problem is basically professional VCs can spend a lot of time thinking about what is a good deal in this market. what is going to be a business that succeeds. Angels often don't have that expertise or that data to hand. And so it's not surprising that most angels have stopped investing.
Mm-hmm.
They stopped investing because of the uncertainty. And not just the uncertainty of your startup, whether it succeeds, but also the uncertainty of their own wealth. You know, will they have money themselves? Do they need to put all their money into a safe, basically, vehicle? And so if you looked at the EIS funds, you looked at basically angel investments, they've been particularly hit. Now that basically confidence may come back, and it may basically come back relatively quickly. It's like a piece of elastic. But at the moment, angel investment is tough. Unless they already know you, they already have a commitment to you, they already have a personal relationship, it's going to be tough to raise some angels until we get some certainty in the market.
That's very interesting. Yeah, it's tough everywhere now, isn't it? Thank you, John. Ollie, there's a question for you from somebody from the audience, and they're asking, what sectors are you focusing on in the next quarter when it comes to new investments?
So as a fund, we have a couple of core sectors. Digital health is a sector we've started to do more and more on, and that continues to be a sector that I think that is one we continue to focus on. I look at a lot of stuff in fintech, and there are some subcategories within fintech that I think is really interesting. I think the idea of putting, like it's the contactless payments world. It's the boom of e-commerce, and I guess in parallel, the whole digital asset ecosystem. I think we're looking at remote working, quite obvious, but we actually had started that at the beginning of the year as a kind of thesis, and so obviously that has been somewhat accelerated. So there's a lot of interesting businesses in and around that space. We're doing a lot in developer first, kind of open source kind of platforms. A lot around enabling developers to be more efficient. A lot around the application of machine learning in the enterprise, and we're doing a bit in consumer. So also looking at some consumer brands. I think that's more aligned to where Jonathan was talking about earlier, which is that really understanding the impact on all aspects of a consumer brand is difficult, particularly to the supply chain. But we tend to back transformative technologies. So there needs to be a kind of core technology aspect to the way the business is operating for us to be interested.
Yeah, so there are quite a few sectors that you're focusing on. Chris, I'm just going to skip to you because we have a question that's addressed to you. And the question goes like, what percentage are you investing in existing portfolio companies, and what percentage are you investing in new ventures in the next 2 quarters?
Our plan will be about 50-50, but of course it does depend how many new deals come along. Of course, it's the one thing about VC is you've no idea. Last year we thought we'd do 6 deals and we did 9. So, but yeah, about 50-50.
Oh yeah, so there's an opportunity out there for new founders to approach Playfair Capital.
Absolutely.
And John, sorry.
Yes.
John, there's a question for you coming next. What would you advise founders to focus on fundraising? What would you advise founders to focus on fundraising or increase sales? If you can increase sales now.
Precisely. I mean, obviously, generally both, if you need it. I think actually firming up at the moment, what most founders have been trying to do the last 6 to 7 weeks is to get really close to their core customers and make sure their core customers are happy and that they keep on using the product and keep on paying for it. And it's going to be very interesting because I think one of the problems of the lockdown in particular, and maybe the social distancing measures, is top of the funnel models. How do you get new customers? Not how do you serve your existing, how do you serve those you've got kind of strong relationships with? But I'm seeing with most of my portfolio, they've done that, but now they're starting to think about how do you do the top of the funnel? How do you actually generate more interest and more leads and more new customers? So I think that is a very interesting thing. And if Jane's got a solution to that, she's basically ahead of the game. So if Jane can do that, then I would say, Jane, go and do that.
Yeah, I think we had a session last week and one of the speakers there said that if founders have a bit of time now, they should analyze their business proposition or the value proposition and see how they can pivot so their product or service can transition from a nice to have to a must have service or product. If they can do that, that'll be ideal, isn't it? Then they can definitely generate new sales.
We've got a webinar this afternoon on pivoting, and I'm quite ambiguous about pivoting because everyone should adapt, but to do a serious pivot from your product and your market normally requires investment and requires time, and there's a big risk, especially if you have no signal. But that, the grass always looks greener, and if you have no signal, basically it could destroy your company as quick as anything. So I'm wary about people going around. I'm wary about people saying, someone told me COVID is a new AI. Every deck's got COVID on it. Kind of like if people are trying to find where they think there will be a market, rather than looking at their own insight, their own expertise, and what they can do themselves and where they have some unfair advantage. So don't pivot unless really you understand what you're doing and you have some evidence that the pivot could work.
Yeah, that's really good. Thank you, John. It's good to have different perspectives because, some perspectives work for certain founders and others.
I'll tell you who can pivot is the pre-seed. The pre-seed have got the massive advantage because they've got knowing basically they don't have a team, they don't have incumbent technology, etc. They can pivot. They can be looking at new opportunities and take a clean piece of paper and say, okay, where are the opportunities now? And I think they are in a really good position if they use that correctly to generate a new generation of startups.
And John, because I've got you here, how do you think that founders can retain their customers now?
It comes back to your point. I mean, at the moment, it's going to be about whether your product really generates money for your clients' clients. If you think about your customers, their major obsession is their own clients. They're in exactly the same situation to you. So if you can think about what their clients' clients are basically up to, and what your product can do to basically make their clients happy and secure them and keep them paying, then that's probably the best thing you can do. And the terrible thing about this COVID is you could find out that your product is a nice to have and not a need to have. And that could be very difficult findings for quite a lot of startups. And then maybe you do have to pivot, going back on myself, but there you are.
Great. I think now we're a bit overrun, so I will start to conclude the session. And I would like to thank you all three, John, Chris, and Ollie, for taking the time this morning and sharing all the insights and valuable advice with us and with the founders who are attending today. Audience, thank you so much for joining us. I do hope you found this time with us, this time spent with us useful. And I do want to bring to your attention that under the Navigating the Crisis, we have a few more sessions, past sessions that you can view them either on the London, the Growth Hub website or on Funding London's YouTube channel. So with that, I do want to wish you all a very good rest of the day, and I do hope to see you on future occasions. Thank you again, John, Chris, and Ollie. Goodbye.